Good afternoon, ladies and gentlemen. Um, Welcome back to our tutorial. And as usual, your tutor of the day is Mr. Fred. And today, I want us to look something more special. And I want your keen attention on this topic which we are going to tackle today. And I'm going to bring comparison so that you see what exactly is the difference between these two. Now, our topic of today is about the principles of importing and exporting. And under these, I want us to see the international commercial terms, so the famously known as the Incoterms. And the Incoterm I want us to see is the Incoterm 2010. But remember, I'm not going to go deep into the Incoterm 2010. Reason being, it has been phased out. There are some few adjustments which have been done into it, and currently now what we have is called the Incoterm 2020. The Incoterm 2020 is going to be in operation for the next 10 years. That is up to 20. It will expire on 31st December 2029. Beginning of 2030, 1st January 2030, you will be having another Incoterm. In brief, what it means that after every 10 years, we get a new set of Incoterms. Now, what does the word Incoterm mean? Incoterm, these are just rules which were made to guide the international trade, because we know that the international trade comprises of a lot of the different parties who take part in the international trade. And when it comes to payment of various transactions in this trade, like the freight charges, the insurance, okay. Or concerning the transfer of cargo from the client's premises up to the port and all that. So those things made experts sit down and said, no, we need to have a uniform way in which the carriage of goods via sea and even over the land can be guided under what we call the trade terms. So these terms normally, it is the importer and the exporter who agrees who to do what and up to which point, okay? So in the introduction, the Incoterms rules explains, rules explain a set of 3 letters, trade terms reflecting business to business practice in contracts for the sale of goods. So the Incoterm rules describe mainly the task, the cost, and the risk. So these are the things which is mostly covered in this in the Incoterms. That is, who does what? That is the task. Who pays for what and up to where? And who bears that risk? Those 3 things only. Okay. So in the involved in the delivery of goods from the sellers to the buyers. So the point what we have to remember is that Incoterm rules do not give you a complete contract of sale. So they do say which party to the sale contract has the obligation to make carriage or insurance arrangements when the seller delivers the goods to the buyer, and which cost each party is responsible for. So they, however, say nothing about the price to be paid. So that one they don't cover. Or the methods of payment. So neither do they deal with the transfer of ownership of the goods. So, or the consequences of breach of the contract. So it is just one of the rules which are required, but it doesn't complete the entire contract of sale of goods. So these matters are normally dealt with through the express terms in the contract of sales or in the law governing that particular contract. So the parties should be aware that mandatory local law may override any aspect of the sale contract, including the chosen Incoterm rules. And the Incoterms 2010 comprises of 11 terms. That is the X-Works, Free Carrier, CPT, CIP, DAT, DAP, DDP, and also there's FAS, FOB, CFR, and CIF. But you will allow me to take you, that is just want you to see how the Incoterm 2010 looks like. But since we are now into the new set of Incoterms, I want to take you straight away to see the new set of Incoterms. And this is now the so-called the Incoterm 2020. And as you can see from the introduction there, it is clearly stated that they are replacing the Incoterm 2010. And the new changes came into force in the 1st January 2020. And the revisions of the rules have been produced by ICC, the drafting group, which was made up of the eight members from Australia, China, EU, member states, Turkey, and the US. So they are developed by International Chambers of Commerce. The International Chambers of Commerce was created as an industry standard to facilitate international trade and for the interpretation of the trade terms that the parties to a contract of sale could agree to apply. So currently, in its 8th version, this is the 8th version, it was first introduced in 1936. And as a global trade developed and evolved, the Incoterms rules were revised in 1957, 1967, 1976, 1980, 1990, 2000, 2010, and now we have the 2010. So today these rules form an essential part of day-to-day international trade, as well as domestic trades, and they form an integral part of many sales contracts worldwide. So it is vital to remember that Incoterms is not generic name for international trade terms, but it is a trademark used to designate the rules which were devised by the ICC. As I said, that we have 11. The 2010 comprises of 11. The 2020 also comprises of the 11. So we have X-Works, FCA, CPT. They're those ones which are, they can be used by any modes. They are, by the way, they're grouped into 2 classes, okay? The ones which can be used by any mode of transport, be it land, air, or water. And those which can only be used by either sea or the inland waterways, that is either rivers or the lakes. Now, so we have the EX, that is X-Works, FCA, that is free carrier, CPT, carriage paid to, CIP, carriage and insurance paid to, delivered at place and loaded, DAP, delivered at place, DDP, delivered duty paid, and FAS, free alongside ship, FOB, free on board, CFR, cost and freight, and CIF, cost, insurance, and freight. Now, let's see them now into little details. In any mode of transport, that is the ones we grouped the first 8, the first 7, I mean, the first 7. Now, the first one is called the X-Works. Now, how does this one work? In X-Works, it means that the seller delivers when it places the goods at the disposal of the buyer at the seller's premises or at another named place, that is, i.e., works factory, warehouse, and all that. So the seller does not need to load the goods on any collecting vehicle, nor does it need to clear the goods for export where such clearance is applicable. Get this one clearly. In X-Works, what the seller does is simply to avail the goods in a sellable condition. That is, like somebody comes telling you, okay, these are the goods which you wanted, okay, from his warehouse. Now, from there, it is upon you, the buyer, to organize how these goods are going to be carried from here up to the port of loading, the risk which might occur along the way when you're transporting them. You are the one to bear that particular risk. If in case, for example, you get an accident and they get damaged, the seller is not there. He's not supposed to be blamed on this. He has cleared with you. Okay, so that cost, risk, and any other thing passes to the buyer at that particular point. That is, now the buyer now takes all other risk and cost which might come from that point. Okay, that is how it works. So in simple terms, what it means that if you are the buyer and you are buying goods on buying the goods from the seller on Xworks terms, you will need to send your truck to the seller's premises and collect the cargo from there and take care of all any other shipping requirements to get it to your destination. So officially, the shipper is not obliged to do anything other than provide you access to the cargo. Get that point clearly. So the key roles of the seller here under the Xworks is to prepare the commercial invoice, arrange for packaging according to the buyer's requirement, ensures the goods are of good quality, and mark or label the cargo. Insurance remains negotiable as no party is obliged to pay. All right. Now, the second one, FCA, free carrier. Now, in Incoterms 2020, free carrier rule now contains an additional element relating to the bill of lading. It was not the case in the 2010. Now, in which the buyer and the seller agrees that the buyer's carrier will issue on board bill of lading to the seller after loading, which means the seller will then tender to the buyer, that is likely through a banking chain. So this is designed to overcome the issue under the free carrier rule. Delivery was completed before the loading of the goods on board the vessel, which prevented the seller from obtaining an onboard bill of lading. Now, see this. We know about the bill of lading. Bill of lading is a document that indicates that the shipping line has accepted your cargo on board. It is issued after your cargo has been loaded on board. Prior to that, the free carrier was only obliging the seller to just deliver them at the port or to the carrier without ensuring that they are loaded. But now it has been a little bit made strict that you must first of all ensure that these cargoes are loaded on board. Okay, then you are issued what's called on-board bill of lading. Now, the risk is transferred when the seller loads the goods to the buyer's carrier. Okay, the goods are at the buyer's disposal and ready for unloading at a named place. So at this point, you as a seller, you'll bear the risk, and the time when the risk will pass from you, when you load these goods on the buyer's carrier. That is the carrier who has been chosen by the buyer. The moment you load them there, then the risk passes from you to the buyer. Okay. Now, the roles of the seller under FCA. What does the seller do now? Prepares the commercial invoice, ensures proper packaging, loads the good to the buyer's carrier, pays export duties and taxes. And what about the role of the buyer under this? The buyer pays terminal handling charges, both at the port of origin and the port of destination, pays freight charges, bears the risk and the cost of delivery up to his premises, pays import duties and taxes at the port of discharge. Okay? CPT, carriage paid to, means that the seller delivers the goods to the carrier or another person nominated by the buyer at a agreed place. If any such place is agreed between the parties, and that the seller must contract for and pays the cost of the carriage necessary to bring the goods to the named place of destination. So the risk is transferred when the seller, from the seller to the buyer, when the goods are handed over to the seller's nominated carrier at a named place. Now, explanation of the terms in CPT transaction, the seller is obliged to deliver the goods to the agreed destination. The agreed destination in CPT terms could be any place expressly agreed between the buyer and the seller, and will most commonly be an overseas destination in most cases. Okay. Roles of the seller: prepares the commercial invoice, ensures proper packaging, performs loading and unloading, pays export duties, pays terminal handling charges at the port of origin, pays the freight, pays terminal charges at the port of destination, bears the unloading cost at the port of destination, bears the cost and the risk of delivery to the final destination, and then pays the import duties and the taxes. CIP, carriage insurance paid to. Definition of the term carriage and insurance paid to means that the seller delivers the goods to the carrier or another person nominated by the seller at an agreed place. An agreed place, if any such place is agreed between the parties, and that the seller must contract for and pays for the cost of the carriage necessary to bring the goods to a named place of destination. Okay, so here the seller is the one who nominates the carrier, and he bears the cost and the risk of carrying these goods up to the point which has been named place of destination. So under this Incoterm, the risk is transferred from the seller to the buyer when the goods are handed over to the seller's nominated carrier at a named place. So the moment you have handed them there to your nominated carrier, the risk passes from you now to the carrier. Okay. However, in CIP trades, the level of minimum insurance has been increased to that complying with the clause A of the Institute cargo clauses, meaning all risks covered subject to exclusions. We know there is clause A, clause B, and clause C. Clause C being the least. But when you're doing your trading under the CIP, take note of this. You are going to take the class A, okay? Which means you're going to cover everything with the exception of the few exclusions only. The roles of the seller under CIP. What role does the seller perform under CIP? Bears the cost, bears the risk of insurance of the goods up to the named destination. So he's the one who bears the insurance. Bears the cost of carriage of these goods to the named destination. Prepares the commercial invoice. Ensures proper packaging, labeling, the good quality of the goods. Performs loading and inland delivery of this cargo. Pays export duties and taxes. Pays freight charges. Roles of the buyer under CIP. Pays terminal handling charges at the port of destination, that is in his home country. Bears the unloading cost at the destination. Bears the cost and the risk of delivery to the final destination. Pays the import duties and taxes. Then, so that is what he does. Then we have the DDU, delivered at place unloaded. DDU, delivered at place unloaded. Now, in the Incoterm 2010, it was known as DAT, delivered at terminal, but has been revised to DDU to reflect that the destination can be any place and not just a terminal. Get that, okay? So here, the destination can be any place, not exceptionally not just the terminal itself. So it means that the seller delivers when the goods, once unloaded from the arriving means of transport, are placed at the disposal of the buyer at a named place. What are the roles of the seller under DGU? The seller must do the export clearance formalities, okay, at your port of loading, pays for the transportation from his door to the named place, including the freight charges, enter into relevant contract of carriage with the various carriers up to the named place, take care of any and all export permits, quotas, special quotation, documentations, etc. relating to the cargo, or bears all the risk up to the agreed point of delivery. Must also ensure that the goods arrive at the agreed place, pays terminal handling charges at the port of destination, pays for unloading charges at the point of destination, bears the cost of delivery at an agreed destinations. What about the roles of the buyer under this? Bears all the import duty and the taxes. The DAP, deliver duty paid, means that the seller delivers when the goods are placed at the disposal of the buyer on the arriving means of transport, ready for unloading at the named place of destination. So the seller bears all the risk involved in bringing the goods to the named place. What role does he perform? The seller. He does the export clearance formalities, just like the same like other roles there. Pays the transportation from his door to the agreed destination, enter into relevant contract of carriage with various carriers, take care of any and all export permits, all risk up to the agreed point of delivery, must ensure the goods arrive at the destination, pays freight charges, pays terminal handling charges to both ports of loading and port of discharge. Take note of that. Text that. Okay? At both the ports. Yeah. Roles of the buyer. Pays import duties and taxes at the port of destination, bears the unloading charges at the port of destination. DDU, DDP, sorry, DDP, deliver duty paid, means the seller delivers the goods when the goods are placed at the disposal of the buyer, cleared for import on the arriving means of transport, ready for unloading to the named place of destination. Hii unaifuata mpaka huko kwao. The seller bears all the cost and risk involved in bringing the goods to the named place of destination and has an obligation to clear the goods not only for export, but also for import. Pay any duty for both export and import and carry out all customs formalities. Now, when you're trying to elaborate deeply on the DDP, may be considered as a term that the other end of the trade spectrum in terms of the obligation compared to the XWorks. Remember on the XWorks, this is the opposite of XWorks. XWorks, we said, the seller does very little, okay? Much of the bulk is on the buyer. Now here, it is now the seller who is doing much bulk of the work. Less work is on the side of the buyer, okay? So DDP is an opposite of XWorks. So if you are the buyer buying on DDP basis, you can take a seat and relax while the seller will do all the export clearance, pay the transportation from his door to the agreed destination, enter into relevant contract, take care of any or other export permits, cover all the risk, ensure the goods are actually arrived at the destination, take care of customs clearance formalities, that is paid. But remember, if you are contracting under DDP and you are the buyer, you will pay heavily. You are going to pay more expensively. The same way, someone buying on XWorks will pay less because much of the work is the one going to do. But if you're buying on DDP, you are going to pay the seller more because remember, this cost is in carrying, he has to recover them because nobody does the business of losing. Everybody want to make money. Okay. Now, roles of the buyer to unload the goods at the destination. Now, rules for sea and inland waterway transport. First, that is free alongside ships, means that the seller delivers when the goods are placed alongside the vessel. That is e.g. on a key or a badge nominated by the buyer at the named port of shipment. So the risk of loss or of damage to the good passes when the goods are alongside the ship and the buyer bears all costs from that moment. So first terms is more suitable for non-containerized cargo because it is in a containerized shipment, the container cannot be delivered alongside the ship, but rather at a container terminal. So for containerized ships, use this FCA, that is free carrier minimum. So if you are shipping a loose cargo, you advise you can use the first. But if you are shipping a containerized cargo, the best Incoterm to use is the free carrier. Okay. What role do the seller perform here? Handle the export clearance formalities, pays for the transportation from his door to the agreed port terminal, will enter into the contract of carriage with the various carriers, including the pre-carriage, take care of any and all the export permits, pays the export duties. What about the buyer? Obliged to organize a suitable contract of carriage with the most suitable carrier. Okay, remember here is this, the buyer selecting the carrier. Okay, the loading of the goods to the ship is its duty, bears all the cargo handling charges at the port of destination, origin and destination, then pays for freight charges, bears the import duty and taxes, bears the cost and the risk of moving the goods up to the destination, and also bears the cost of unloading of those goods. Free on board, a very common one. Now, free on board means the seller delivers when the goods on board the vessel nominated by the buyer at a named port of shipment or procedures or procures the goods already so delivered. The risk of loss or damage to the goods passes when the goods are on board the vessel and the buyer bears all the cost from that moment onward. So in FOB, the seller has the obligation to deliver the goods on board the ship. Since in FOB, goods have to be delivered on board, it may not be appropriate for goods which are handed over to the carrier before they are loaded on board, like the containerized shipments. So it is still used by most people to refer to cargo for which freight is collected at the destination and where the contract of carriage is fixed by the buyer. So the FOB term has some extensions such as stored and trimmed, which are designed to ensure that the seller completes the activity of loading. So they are used when trading in cargo such as grain, minerals, which may cause storage issues. And if it is left untrimmed, or cargo such as pipes, logs, which may also cause storage issues if it is left unstored. Okay, so if the FOB is stored, which means that the risk will only pass to the buyer when the goods have been delivered on board and they have been arranged accordingly. If it is FOB trimmed, which means that you have leveled them, you have delivered them, then they get levels, things like grains. The grains, you know that they're those free-flowing materials, so they have to be leveled so that the balancing of the ship to avoid those effects which normally occurs when the ship is not properly loaded. Things like the hogging of the ship when the aft or the fore is carrying too much cargo. Okay, then we have the problem of what called the hogging. Okay, this one here. Then we have the problem of tilting. The tilting, when either the starboard side or the sea side of the ship is having too much cargo, then you can have that effect of tilting. Then we have the problem of sagging, the sagging, okay, when there's too much weight at the center. So all these ones, they can be avoided with the proper storage plan and trimming of the cargoes, okay? Now, there also the seller under FOB, handle the export clearance formalities for shipment, pays for the transportation from his door till the goods are loaded on board a ship, enter into relevant contracts of carriage, take care of any of all permits, quotas, special documentation, cover all risk up to the agreed point of delivery. Then what the buyer does here is that the buyer pays the freight charges, bears the import duties and taxes at the port of destination, bears the cost and the risk of moving the goods up to destination, and bear the cost of unloading. So in FOB, normally we have what called the freight collect, which means that it is the buyer who is going to pay for the freight at the port of destination. All right. Now, roles of the seller under the roles of the seller under oh, sorry. So we have the cost and freight, that is CFR. Now, it means that the seller delivers the goods on board the vessel or procures the goods already so delivered. The risk of loss or damage to the goods passes when the goods are on board the vessel nominated by the seller at the origin. The seller must contract for and pays for the cost and the freight necessary to bring the goods to the named destination. That's why we have this one here, the cost and freight. Okay, so the seller is the one who pays for that. Get that? So in CFR transaction, the seller is obliged to arrange for the movement of the cargo to the named destination. And since CFR may be used only for waterway transport, this destination must be destination accessible through the waterways. Now, the risk passes from the seller to the buyer once the seller delivers the cargo on board the performing vessel. So whereas the cost after the named destination will still be for the seller. Also the seller under the CFR pays export duties and taxes, pays for the transportation from his door to the named and the agreed destination, take care of any and all export permits, pays for the terminal handling charges, ensure loading and inland delivery. What about the buyer? The buyer here pays terminal handling charges at the destination, bears all the costs and the risk of delivery, bears the unloading charges, and pays for the import duties. Now, the last one is known as the CIF, a very common one again. Now, means that the seller delivers the goods to delivers the goods on board the vessel or procures the goods already so delivered. The risk of loss or damage to the goods passes when the goods are on board the vessel nominated by the buyers at the origin. The seller must contract for and pays the costs and the freight necessary to bring the goods to the named port destination. The risk passes from the seller to the buyer once the seller delivers the cargo on board the performing vessel, whereas the cost up to the named destination will still be for the seller. Okay. Now, under the new Incoterm, that's 2020, the level of minimum insurance in CIF has diverged. That is, CIF terms continues to require the seller to obtain cargo insurance, complying with the clause C of the LMA and IUA Institute cargo clauses. So we see, as I said somewhere there, that we have got the clause A, we have got clause B, we have got clause C, and under the CIF, you are still required to take the lowest. That's the clause C. Okay, yeah. Under the rules, bears the minimum insurance cover, but is free of a particular average, pays export duties and taxes, is paid for the transportation from his door to the agreed destination, take the care of all export permits, quotas, special documentations, pays for the terminal handling charges at the origin. The rules of the buyer under the CIF is that the buyer takes care of any transport movement past the agreed place of destination. The risk from the time the seller delivers the cargo on board the ship, and any and all import permits, the quotas, and import customs clearance and all related formalities. Now, there are things which you need to note in the new 2020. It contains 6 significant changes which were made from the Incoterm 2010. One, the free carrier rule now contains an additional element relating to the bill of lading. This was not there. Okay. And under this option, the buyer and the seller agrees that the buyer carrier will issue an on-board bill of lading to the seller after loading, which the seller will then tender to the buyer. That is likely through a banking chain. And this designed to overcome the issue under the old FCA rule. Delivery was completed before the loading of the goods on board the vessel. So which prevented the seller from obtaining an onboard bill of lading. So this issue has been addressed here. So this caused difficulties because the onboard bills of lading are often required by banks before making any payment under the letter of credit. And therefore, the FCA rule was revised to take account of this particular reality. I think you understand that. Now, two, the costs are now consistently listed in A9, that is the seller's obligation, and B9, the buyer's obligation, providing a one-stop list of cost for each rule. So this new consolidated cost section appears in addition to the allocation of the cost under the relevant obligations. For example, in FOB sale, the cost involved in obtaining delivery to transport document appears in both A6 and B6, and A9 and B9, okay? Now, the level of minimum insurance in CIF and CIP terms has diverged. In CIF terms, continue to require the seller to obtain a cargo insurance complying with the clause C. So there is a difference here of the LMA and IUA Institute cargo clauses. But when you look at the CIP trade, the level of minimum insurance has been increased to that complying with the clause A of the Institute cargo clauses, meaning all risks are covered subject to only the exclusions. Okay. Now, the provisions has been made for the seller or buyer to employ their own means of transportation rather than employing a third-party carrier, as was assumed in the Incoterm 2010. So the changes are reflected in the FCA. When you look at the DAP, the DPU, and the DDP rules, you'll find that one there. Then the DAT, that is delivered at terminal rule, has been renamed now. It is now not called the DAP now, but it's called the DPU, delivered at place and loaded. So this is also this also is also to reflect the destination can be any place and not just the terminal. Okay. So, and lastly, an express allocation of security related obligation has been now added to A4 and A7 of each Incoterm. So the cost of which are included in the A9 and B9. So for example, we have the A4 and of the FOB Incoterm, which states that the seller must comply with any transport related security requirements up to the delivery, up to delivery. So these provisions reflect the increasing prevalence of concerns relating to security in the international trade, right? So up to there, that is a short brief on a short brief on what you need to know on the Incoterm 2020. So kindly, we have got some articles which read the entire document in more details. Mine was just to give you a guide and get a clue on what it entails. And I think you have now understood it well, what it exactly contains. So after understanding the Incoterm 2020, I want us also briefly look at the shipping documents, which are, again, I know we have talked about them sometimes back there. We have things like the commercial invoice, we've talked about it. It's normally issued by the seller stating what has been sold and the sales price, okay? Booking confirmation is a document issued by a freight forwarder confirming all the details of the booking you have made, except for the actual cost of transportation. So if you made a booking with a freight forwarder, they give you what we call a booking confirmation. Then forwarder's cargo receipt is issued by the freight forwarder or his agent to the shipper of the cargo when the cargo has been handed over to the freight forwarder. So it serves as a confirmation that the cargo has been received for shipping. So the FCR does not confirm the conditions of the cargo, nor does it confirm nor that the cargo has left the country of origin. Then we have the forwarder's invoice. A forwarder's invoice is issued by the freight forwarder to the shipper or the consignee. This is a documentation for transportation cost and for the service included in the solution purchased. So the document normally specifies the unique booking references, the billing address, and what is included in the transportation service. Then we have the house BLs. The house BL is issued by the freight forwarder to the shipper with the following purpose: receipt of the goods which are shipped, the document of title, the proof of contract. And why do we issue a house BL? House BL is issued in cases whereby the shipper did not have a cargo that can make a full container load. So these cargoes have been done what called consolidation. They've been consolidated into a container, and they're now being shipped as LCL cargoes, okay? Not an FCL, but LCL cargoes, okay? So in that case, you'll be given a document known as the house BL by the freight forwarder. Telex release, these are some forwarders offer telex release of shipment. This means that the regional house BL can be surrendered to the freight forwarder or the forwarder's agent at the origin, who then instruct the office of destination to release the cargo, the consignee. Then the master BL. The master BL is issued by the shipping line to the freight forwarder. Now, this comes whereby the freight forwarders, they approach the shipping line that they need space. So the shipping line will sell for them the space. After selling for them the space, then they come back to the shippers. They these normally shippers with the small consignments which cannot make a full container load. So the shipping line will give the freight forwarders a master BL, and the freight forwarders will give the shippers what we call the house BLs. Okay, yeah. So the master BL covers all the shipments inside that container, while a house BL covers individual shipment inside that container. Seaway. Now, it has many similarities with the house BL, but does not require an original to be surrendered to the freight forwarder before the cargo can be handed over to the consignee. So it is not a negotiable document, and is not a document of title, as we mentioned it somewhere. So the Seaway bill can be a good solution when goods are already paid before the cargo leaves the origin. So it simplifies the process, and the consignee will simply need to prove his identity to take delivery of those cargoes. Insurance certificate, as you know, normally it authenticates that particular cargo has been insured by a given insurance company. Customs clearance and payment of duties is part of the international shipping. Customs duty is an indirect tax on the import or the export goods in the international shipping. So various countries have got various ways in which they collect this particular duty. Customs clearance process, that the customs officer will look at the paperwork for your shipment. Once your cargo has arrived at the port, now they need to clear it. The officers will first check your papers just to justify that are they rhyming with whatever is there. Is a commercial invoice tallying with the packing list? Okay, yeah, and any other thing. So the officers check on the paperwork for all the shipment. Then the customs officers will see if any taxes or the duties apply to a shipment. So if your cargo is dutiable, then they'll ensure that the duty has been calculated right in the right way. You have not underquoted, and the duties have been paid. Now they will request payment of taxes and duties if they haven't been paid. So if you've not paid, then you will have to pay. So this is where the DDU, DDP normally comes into effect. Okay, yeah. So as you can see them there. Now, once it is confirmed that the outstanding taxes and duties have been paid, then the shipment is released and continues on its final destination. Okay. Now, the Kenya's experience on how these customs documents process are done. Import, the importer or agent, all customs procedures are declared in a single entry form known as the C63. And the importer or the agent completes the entry and access duty and the taxes. He then pays the duties and taxes at the bank and present the entry plus all the supporting documents to the customs. Now, entry reception point, the entry is received from the importers or the agent. The entry is checked against the supporting documents and the data in the entered into the computer. The data, duty, taxes, payment screen is checked against the entry and is passed if the results are satisfactory. Declaration point, what happens there is that the entry is passed through the declaration point where the customs documents are checked for validity and completeness. Information checked includes the duty assessment, the origin, the tariff, classification, value, and exemption claim. The declaration officer selects a consignment for inspection based on the risk assessment. Then the entry control officer issues a release order for the consignment, subject to inspection, sends the entries with supporting documents to the inspecting officer. Then when it comes to inspection, the inspecting officer inspects the goods, endorses the result on entry, and if satisfied, issues a release order. Manifest section, what happens here is that the reconciliation takes place of the entry, manifests either directly or through examination or port operators records. So overages and or short-landed goods are dealt with, then entries plus supporting documents are sent to the port post-release verification. Then post-release verification and audit. Post-release verification and audit may or may not select entry for further scrutiny depending on the risk records. Then export. The export processing procedures are similar to those of import, but simpler. So entries are received, checked for completeness, manually recorded and stamped, passed to the declaration officer for scrutiny, and all documents of all documents and verification. Now, for sensitive export, a check is made on the authority of export, then triplicate copy of the entry submitted to statistics section for data processing. Reports, the statistics division receives the data from the 6 major offices, which is entered automatically through the buffering system, while at the remote office submit the triplicate of every passed or certified. Then the remote offices forward some of the data in diskettes, which is combined with other data. Then the buffering system generates a report monthly or according to the user. Then custom systems, a Secuda system is used. A Secuda, they use a Secuda system, which is currently in use. Then the system is operational at the major KRA offices and all that. So the system is operational. The major KRA offices, customs offices support of day-to-day operations since back in 1996. So other remote offices use ordinary computers and laptops nowadays. And in fact, currently what is being used, we use single window, which the buffering things are passed. So right now we are using the single window, which has even summarized the entire thing. Okay. So the customs offices, the number of customs offices in Kenya are around 48, comprising of 6 major and 24 small. Most of them are at the border station. So the remote offices are not connected to buffering system, hence the delay in the receiving. But nowadays, the buffering system, this one is an outdated system. We right now use what called the single window system. So all of them are now connected to single window systems, what is now being used. Forget about that buffering thing. Declarations, the number of declarations handled also is growing over the years. Right now, we have several number, which because of the system is workable. Right now, it was an agreement within the East African countries that they all install the single window system, and the single window is now, according to the FAL convention. FAL convention is one of the conventions which is looking at mambo na baharia, mostly concerning the number of ships visiting a port, the number of vessels which got to the casualty during how fast they stay at the given port and all that. So the FAL Convention requires that in the East Africa, since we are member states, we need to activate our single window system, and Kenya is in the forefront of that through the Kentrade. So time schedule, the customs office with the technical assistance from the World Bank has carried a lot of operations on that. So in the evaluation, rule of origin, about those ones. Receiving of the consignment and record keeping. Receiving procedure is needed to properly inspect all incoming cargoes, mark them with the tags, and record them as having been received. So inspecting incoming goods, that is receiving staff upon receipt of the delivery, match the received items to the description. So much of the verification, compare what you have and what is in the document. So if there is any unauthorized purchase order, the purchasing manager does not issue a waiver, reject the delivered goods. So use pre-printed receiving checklists to inspect each delivery items. Then identify and tag all the received inventories, that's the cargoes, log in the received items, Then government roles in the international trade policies. What role do the government perform in the international trade policies? International trade policies describe collectively the international laws and the multilateral lateral trade agreements that governs the sale of goods between different nations. So some international trade policy is made by transactional institutions like the UN, uh, WTO, which are not directly controlled by any particular government. So instead, member governments elect representatives to those transnational bodies in much the same way as the citizens elect representatives to the legislature. So most substantive international trade policies is actually in the form of multilateral trade agreement. Then we have also the NAFTA and the Trans-Pacific Partnerships are examples of such trade agreements. So the agreements primarily involves the negotiating reductions in tariffs and the protection of the intellectual property. They are often negotiated in secret directly between executive members of the government and ratified with little oversight by their respective legislatures or the citizens. An advantage of this method is that agreement can be resolved relatively quickly with less partnership. But a major disadvantage is that this lack of oversight can make the process undemocratic and give undue advantage to particular interest groups. Banking and finance practices. Banking and finance lawyers deal with the lending and the borrowing of money and the management of financial liabilities. So the risk is their task is to help structure their clients' transactions to protect their clients, best legal and the commercial interest, and negotiate and document the transactional relationship between the lender and the borrower. So we have, if anything, for anything banks do with their capital raising or the financial instruments in the capital market, like we have straightforward bank lending, acquisition finance, real estate finance, project finance. So there are different types of finance, asset finance, Islamic finance, and what they need, financial service regulations, and what the lawyers do, bank lending, that they meet with the clients to establish their specific requirements and the commercial context of the deal. They carry out due diligence and investigation exercise to verify the accuracy of the information, negotiate the opposite party to agree the terms of the deal, and assist the structuring of the complicated, groundbreaking financial models. They also gather all parties to complete the transaction. And in a secured loan, most bank that is ensure that the agreed upon collateral has been properly granted, and that all the filing, registrations, and other procedures necessary to perfect the security have been or will be made. Now, there's a financial service, the regulations receives calls from the bank, sit down with the client, they analyze the implications of the implementing that plan, they give advice on what changes may need to be made. Regulatory lawyers are also not just involved in the compliance of the counseling, but they are also advised to advise on enforcement and the internal and external investigations. So up to that point, we call it the end of our interaction. And I look forward that we are still going to interact more on some other entertaining topics. This was majorly for the mercantile and the shipping practice. We're still going to meet in other units as I continue to lecture you and tell you the insight requirement in the shipping industry for the 21st century. Up to next time, I say goodbye. Have a good evening, and remember to subscribe to the channel and stay tuned for more updates. Thank you very much. Bye-bye.